Hi, I'm Max Keiser. Welcome to the Keiser Report. Let's talk about how the global economy is shaping up here in the 21st century. Stacy?
Right. We've been talking about the inflation, hyperinflation, inflation coming, and the $6 trillion budget presented by Joe Biden. So that's a 25% increase in the budget. And, some people are saying, oh, it's going to be fine. Janet Yellen at the Treasury says, you know what, we have plenty of money. Interest rates are going to stay low, so the government could afford all this debt. Many, on the other hand, say, well, this is going to drive inflation even higher. This one really caught my eye, Max. The cost to ship goods to Europe from Asia shot above a record $10,000. These are the record shipping container rates from Asia to Europe. You see that parabolic move? That looks pretty bad.
The prices of stuff are going up. And people are mentioning this, that the prices for energy, food, transportation are going up at an alarming rate. And the government is telling us that don't believe your eyes, that that's not inflation. And people are starting to question whether or not their governments might or might not be out of their minds.
Well, certainly the Fed is saying it is all transitory, right? This is just transitory inflation. It will all settle out. But the thing we've been looking at is the mindset, because remember, all that Fed speak is about controlling the psychology of the population, keeping them, convinced that the Fed and the Treasury have everything under control. Well, car and truck sales show the inflation mindset has changed. Consumers are willing to pay a lot more, generating not only record sales, but also record gross profits. This change in the inflation mindset is likely not temporary. So, Wolf Richter over at wolfstreet.com, his background is in automobile sales. So he loves this sector and has a lot of great data here. With the auto sales, he says that record new vehicle retail sales, despite slashed incentives by automakers, record new vehicle transaction prices, spiking used vehicle prices and trade-in values, very tight inventories on popular models, and record dealer profits. That's what stimulus and stock market gains, along with supply disruptions, produced in May. It has inflation written all over it as the whole mindset has changed.
Well, this is amazing because I'm very happy when we get rid of all the central banks because, for example, when people are saving money, they say the reason we have deflation is because people are saving money. So we're going to have to print lots of money. Then when people are consuming and they're doing so at a rate in response to that printed money, the central bank says, well, you know what? People are consuming too quickly. They're causing the inflation. Had nothing to do with their money printing. And so the response, by the way, will be to print more money. But they're going to call it a different policy than quantitative easing or monetization of debt. They're going to call it something different, and they'll refuse to accept that it is inflation. They won't call it inflation. Prices will continue to go up. When price of food hits a certain critical level, you're going to have riots everywhere, as you always do throughout history. But they won't call it inflation. And so we're on the verge now of a global insurrection against banker occupation. This is what we've been predicting now for 10 years. It'll be caused by an inflationary depression, by money printing. The escape valve is Bitcoin, as Christine Lagarde herself admitted and made a very articulate point about that. Bitcoin is the escape from our policies, as she said. And what we said was going to happen is now unfolding before our very eyes.
Yeah, and remember we talked about the fact that Michael Burry, the hedge fund manager who had done the big short back in the last financial crisis, well, remember he is preparing for hyperinflation. And he's preparing by shorting U.S. Treasuries, which is a remarkable thing to do. But, he always compares right now to Weimar Germany. And you do see that interesting, really speculative craze, like the kids on Robinhood and taking on, GameStop, and then AMC has been going berserk over the past week. So this could be a very interesting summer. It could be like back in the days of the 60s and 70s in terms of how unusual things might get.
Right. Well, back in the 60s, people used to burn their draft cards in response to the Vietnam War and the sad tragedy of a state gone mad. Here, they're on Robinhood trading meme stocks, the equivalent. It's a protest. It's a protest against the state gone crazy. And the ultimate protest is Bitcoin, and it's available globally.
I read a funny thing on Twitter where somebody said, imagine having spent like $200,000 on an MBA from some top business school, only to see all your analysis and how you look at the balance sheet of any corporation you're thinking of investing in when meme stocks just outperform you.
Well, we called this a couple of years ago. We started referring to the Bermuda Triangle of finance, because with interest rates are at zero, then there's no gauge, there's no radar, there's no way to determine future cash flows and apply any kind of a discount rate, because your price of money is zero, in some cases down negative. So that leads to meme stocks. That leads to swarms of Robinhood traders, like murmurations of starlings in the sky, simply moving in and out of names willy-nilly without any rhyme or reason. And that's a postmodern, post-capitalist society, an empire on the verge of collapse.
So Weimar Germany, look at the hyper-consumption and anybody buying anything they can while they can. Things feel good at the beginning. And well, back to the car and truck sector, the average transaction price, which is called the ATP, of new vehicles sold to retail consumers in May reached a record $38,255, according to J.D. Power estimates. The ATP is a function of the price of new vehicles sold to retail customers and of the mix of new vehicles sold. The shift to higher-end trucks and SUVs that we have been seeing in recent months helped push up the ATP. The chart, based on the data provided by J.D. Power, shows the months of June and December and every year except in 2021 when it shows the ATP for May. So as you see, the price, the average transaction price is jumping, and it's almost exclusively to people just really buying all those SUVs and at a way higher markup. The automakers are making a huge markup on those compared to what, like almost twice as much as what they make on a sedan, in terms of how much they mark it up. But people are not, there are no incentives. Car dealers are not having to offer incentives. People feel very wealthy. Their house prices are going up. They're getting so much stimulus. Their paychecks are going up with, the enhanced unemployment benefits. So people are out there spending, and that's the mindset that is really crucial.
Well, they have no confidence in the U.S. dollar. They treat it like confetti. You remember 20 years ago or so, the Beanie Baby craze. People would spend $1,000 for a Beanie Baby or something like this. And now we've got that same mentality applied to cars and trucks and houses and other vital components of the economy. There's simply no end to the money printing. A lot of people can access it for zero cost. And so they're out there splurging it without any thought about how this relates to their life. And the result is an economy that is disintegrating in real time and causing social unrest, social problems, political uncertainty, social cohesion problems, and lots of other systemic and debilitating societal ills that have resulted in a weakened state of the psyche of the nation. And will it be able to compete against other countries in the world going forward? My bet is going to be challenging.
Right. And again, back to the Weimar Germany sort of situation, you do see it's bizarre, or perhaps it makes perfect sense that the consumption has gone into overdrive and prices have gone into overdrive, whether it's the property prices, automobile prices. Usually automobiles, they famously, you drive off the lot and they drop by 20, 30% in value. Well, you see that on Twitter. Look at people talking about their car value. It's like they bought a car 3 years ago, they put 30,000 miles on it, and now it's actually worth more than what they bought it if they sold it in the used car
Right, what's
market.
happening on the wholesale corporate market? So Jeff Bezos bought Whole Foods, he bought MGM Films, and it cost him nothing because the cost of financing was zero. Louis Vuitton bought Tiffany Jewelers for less than nothing. The ECB paid them to buy that company. So it's happening on the multi-billion-dollar level. So it's happening also on the retail level with cars and trucks. So nothing is going to stop inflation now. It's becoming Weimar Germany in a lot of respects. And I think if you look at the history of Weimar Germany, it was really compressed into a 12-month period where you saw, let's say, the currency had a 1-to-1 relationship with gold. It eventually went over $1 billion to 1. And I think if you look at what's happening in these other countries like Venezuela and Turkey, and you're going to see something similar to the US dollar.
You could see that it does, the hyperinflation mindset where it's total euphoria at the beginning. So you see, like, once something gets set in motion, so like the fact that so many Westerners in particular are focused on their house price and they feel rich when it is going up in price, even though the cost of maintaining and taxes and all that sort of stuff and the next generation gets locked out. But you see, like, if people are thinking like, okay, I'm going to go buy this car, there's no risk to me, right? Because I'm going to drive it off the lot. I'm going to drive it for 3 years, going to put 30, 40,000 miles on it, and I'm going to actually sell it for more once.
I'll give you an analogy. Once, I remember this Coke machine was broken and giving out free drinks.
Yeah.
And so very quickly a crowd assembled.
Yeah.
And they were taking all the free drinks. Then, of course, it ran out of drinks.
Yeah.
And it took months and months to get the thing repaired. So here in America, you've got people giving the free stuff, but now the economy is breaking down. You see shortages in chips and other vital components of the economy are not there. They're breaking. So once that ultimately collapses, the time it takes to restart this behemoth is going to be months and months, years and years, potentially, and the rest of the world's going to be like, adios, America. We're taking this century. You had the last century. We're taking the 21st century. Speaking of taking stuff, we've got to take a break. And when we come back, we're going to be here, and it's going to be fantastic. So don't go away. Welcome back to the Keiser Report. I'm Max Keiser. Time now to return to our conversation with Michael Pento of pentoport.com. Michael, welcome back.
Thank you.
So in the first segment, we were talking about the bond market, and a lot of what we're talking about falls under the category of price signals are broken. For example, when they go into negative interest rates, that hadn't been done or very rarely done in the past. And it's very confusing for players in the market, yourself included. Being a money manager, you rely on price signals. That's something you key in on to allocate capital. So are all price signals broken, or and additionally, maybe there's some signals that you key in on that are giving some good feedback, Michael?
Well, I look at break-even spreads. I look at the CRB index, so lumber prices, oil prices, copper prices, home prices. Oh, by the way, the Fed doesn't really count it's very easy just to look at Zillow and say, what are the home prices up year over year? Oh, I'll use that as my inflation component. No, they say, gee, what do you think you can rent your home at? What do you think? So I look at real market, whatever is left of the free market, those real indicators. And they've been telling me for quite a long time that we're in an inflationary spike. My point of view is this: I don't look in the rearview mirror. I look forward. And what I see coming forward, especially into 22, is the end of fiscal and monetary support and the effect that's going to have on this massive and unprecedented asset bubble in the stock market. And by the way, there's an echo bubble in the real estate market too. And of course, the center of all bubbles, we've been talking about it, is the bond market. So, I believe that we're going to have a disinflationary environment rear its head, thankfully, towards the end of this year and into 22. And I think that is very likely going to morph into a out-and-out deflationary environment in 2022 as the Fed winds down its quantitative easing program. And we end up with a good, I would say we have one of the worst credit market catastrophes we've had, including the great financial crisis of 2008. That's how devastating I think this market's going to be. And I just want to say, just in my defense, before people think I'm a Cassandra, don't forget, in 2019, the repo market froze completely. That is before we had COVID. That is before we had interest rates. Interest rates back then, we went to 2.5% on the Fed funds rate. 2.5%, not 5.25% like it was in December of 2007. 2.5%. And that was enough to cause the train to fall off the tracks, the economic train to go off the rails. So I think we're going to have a credit crisis like we have never seen before, even worse than 2008. And that is very deflationary in nature. Watch to see what happens when the Fed tries to end QE and normalize interest rates. Watch what happens to the repo market and the credit market.
What happens with our Congress if they try to unwind UBI and all this free money that Americans are getting? If you're staying at home, there are something like 18 million people still unemployed, and they're collecting $300 enhanced unemployment benefits. There are now massive shortages of labor across the United States. How do they unwind that free money?
Well, they're already unwinding it, Stacy. This is one of the reasons why I think we're going to have a deflationary problem in 2022. In fact, I think it's a healthy thing. But let's just say the Fed printed in 2020 to 2021, the Fed printed $3.5 trillion. That was the expansion of the balance sheet. The following year, which is this year, we're going to increase the balance sheet by $1.44 trillion if we don't start to taper the balance sheet. The next year, we're going to do something in the hundreds of billions. And it's the same thing with the helicopter money. People are no longer getting $1,400 checks in the mail. 21 states have ended enhanced unemployment. Used to be 600, then it went to 300. Now it's going to be 0. And September 4th, there's no more enhanced unemployment. And even the child tax credit, which was increased, that goes away the end of this year. So there's going to be no helicopter money. There's going to be no enhanced unemployment. There's going to be no child tax credit. And it's going to be very difficult to get anything substantial, anything close to the $6 trillion. I mean, it'll just be a few $100 billion in nature passed. Don't forget, you have the gentleman from West Virginia who's going to block a lot of things in the Senate. Any huge, massive spending programs. He's a moderate Democrat. So I think we're going to have a fiscal and monetary cliff in 2022. And why do we have this inflation problem now when we didn't have it before? It's because we gave money directly to people. And we gave more money to people than if they had a job. 25% of the people collecting unemployment are making more staying home, not producing goods and services, which could absorb all this money printing. So once people go back to work, the bottlenecks should ease a little bit. They're going to be making even less money than they were staying home. So I don't see the inflation problem really coming to the fore until we have the next crisis. Then, Stacy, you're going to see universal basic income, modern monetary theory in a permanent basis. Republicans and Democrats will assent to it. That's going to be your cue for intractable inflation, and it will be your cue for bond yields on the long duration side of it to become unglued. And here's the thing, I want to just leave you with this note. The idea that anybody in this country has faith in our central bank to nail any inflation rate is ridiculous. Max, we're talking about the 70s, inflation being where it was in the 70s, if we measured it correctly before the Boskin Commission. If you measured inflation correctly, where we were in the 70s, but think about where interest rates had to go under Paul Volcker. He had to take the Fed funds rate to 20% to kill inflation. Could you imagine what a 20% or even, Max, even a 10% Fed funds rate would do to the real estate market, to the stock market today, to the credit market today? It's unthinkable. But inflation has a way of getting out of control. The Fed says, here's my favorite thing from the Fed. Well, Laird Brainard said today, we have the tools. Jerome Powell, we have the tools. Well, go ahead. I say to the Fed, go ahead. If you want to squish inflation that gets out of control, let me see you jack up your Fed funds rate quickly. And let me see what happens to the stock market. See how long that takes them to change their mind.
On top of the UBI or these enhanced unemployment checks and all the stimulus checks going out to most American families, There has also been a rent and mortgage moratorium, and it extends to the end of the year. So some people have gone 2 years by the point this ends without having, almost 2 years without having to pay any rent or mortgage. Clearly, they're not going to have been like saving up that money and plan to pay back one day. So like, what happens at that point when they have to pay?
You're such a genius, Stacey.
I know. That's why I'm here.
I just love you.
That's why Max brought me on.
Sometimes we do live interviews, you can't remember everything. But starting in March of 2020, we had this mortgage forbearance, right? You'd have to pay your mortgage. That was extended out to 18 months. So starting in the fall, not only will people no longer have their enhanced unemployment, or will they have their child tax credit in December, or their $1,400 per person in helicopter money, they're going to have to start making mortgage payments. And what about the 18 months in arrears that they haven't paid? So I don't think they have to pay one lump sum, but they're going to have to start making, at least amortizing that over a short period of time. So people are going to have their savings drawn down very, very quickly in the latter portion of 2021 and into 22, which is very deflationary because you're paying back debt. When you pay back debt, it's deflationary.
Now, one of the most extraordinary signals of sorts is the one that people are making with their feet. Michael, we've seen a mass exodus from both New York and California. In California, they've had their first population decline ever. Michael, we can't help but notice that you're still in New Jersey.
New Jersey.
New Jersey, and as a follow-up to that question, Michael, I want to ask, do you agree with the recent poll that suggests that New Jersey, in fact, has the best pizza in America?
Well, I think I make the best pizza in America because it's an old Neapolitan recipe from my grandmother. But to your point, I mean, I'm trying to buy a house in Naples. I come on these programs and I get emails. Oh, you're buying a house in Naples. What's that like? Well, Naples, Florida, the home prices are up like 80% in the past few months. It's ridiculous. The real estate agents say there's just nobody that's willing to sell their house because they can't sell their house because if they sell their house, unless they plan on dying, they have no place to live. There's no place to buy and there's no place to rent. This is the most illiquid real estate market ever. First-time home buyers have been completely shut out of the market. Thank you, Jerome Powell, who's trying to eradicate some kind of bifurcation in the economy between the rich and the poor. He's caused it. He's caused this to happen. And I don't see any way you're going to have first-time home buyers get back into the real estate market unless home prices crash by 30%, like they did back in 2008, which, by the way, is entirely possible to happen once again. Even though underwriting standards are better this iteration than the bubble leading up to the Great Recession, home price to income ratios have never been higher. And inventory has never been lower. So you have an echo bubble like we had in 2000 and 2003 to 2007, and home prices will probably correct. And I think they could correct violently, predicated upon how low the stock market goes after the fiscal and monetary cliff arrives.
Yes, but as we were talking about the mortgage moratoriums, that's part of the reason why we have such low inventory, because there would be a lot of inventory is often usually, people being evicted and losing their home. That's not there anymore. But again, like the problem is 2022 is midterms. So what are the Democrats going to do? They're going to I believe they'll extend that moratorium on mortgages and rent, because nobody wants to face a pile of $10,000, $20,000 that they suddenly owe.
The road to hell is paved with good intentions. I mean, I'm from the government. I'm here to help. You can, mention any aphorism you want to mention, but look what the damage they've caused in the real estate market. I mean, even realtors aren't making any money because there's no volume. There's no transaction volume. A house pops up. It goes in, one day cash, well above the offer. And there's no volume in the transactions. But to your point, Stacy, absolutely, you're absolutely correct. They might extend the mortgage moratorium for a little bit, but what's on the other side of that ledger? Does anybody ever ask what is happening to the person who is actually investing in these homes and rents it out and has received no income for 18 months? And some of these people aren't BlackRock, and they're not private equity firms. Some of them are. Some of them are just average people who saved a little money and instead of blowing it in the stock market, decided to buy a second home and rent it out. Who's speaking for them? But in either case, Stacy, in either way, even if you continue to ruin the investor side of the balance sheet, it's not going to be enough to offset the massive fiscal and monetary cliff coming in 2022. Again, $6 trillion was spent by the Treasury in helicopter money, in payments for people, PPP loans, corporate bonds were purchased. Everything was bought under the sun except for stocks. All right, that is going away. It cannot and will not be duplicated until we have another credit crisis, which is coming in 22.
Landlord lives matter. Hey, so Michael Pento, best Neapolitan pizza chef on the East Coast in America, as rated by New York Magazine, and he's happy to cook you dinner at his home. Just call him up, and he'll happily do that. Thanks for being once again on the Keiser Report.
God bless you both. Happy to be here as always.
All right, well, that's going to do it for this edition of the Keiser Report with me, Matt Keiser, and Stacy Herbert. I want to thank our guest, Michael Pento of pentoport.com. Until next time, bye, y'all.